it's not here. All right, guys, welcome everybody to AMA number 21. This is gonna be a slightly different from the usual thing because as you can see on my screen, I'm sharing the market cycle science tool. It used to be called the Astro Cycle Visualizer, but the AI came up with that. So if audio is good and video is good, let's just start. Now the reason, Parrot, just let me know if there are any issues. All right, perfect. The reason I want to start here, not with the treasury, actually, yes, let's start with the treasury market. I want to do treasuries, I want to do oil, I want to do stocks, and then I want to go into crypto, and then we'll go into the traditional trading view macro style visualizer. Now, why do I want to start here? Because I can't actually point to price action and justify my view, although that will make sense in just a minute. Let me zoom in here. This is the visualizer for an 18-month cycle in the treasury market. This is the 10-year treasury. Now, of course, anybody who trades bonds, you know that they're all correlated. So what this new model that I've been building, still building it. Honestly, the model is pretty much built. What I'm building now is the UI, so the user interface. Hopefully you like it. Send feedback if you don't. This has to make sense for you guys because I built this initially for myself. I was looking at all these forecasts using Excel spreadsheets, which is, if you've ever tried, it's extremely frustrating because I wanted to get the actual dates and what have you. And then I said, you know what? I have an AI. Like I can just build anything now with AI. Just a little bit of developer experience. I've taken courses along the years. I was never a full-time dev. I am now. I've been coding nonstop for years now. It's mostly, if you look at what I spend most of my time on, it's coding, just writing code, but usually back-end stuff. I was not a front-end guy until AI came along. And what you're seeing here, actually, guys, is just TradingView has an open source library. This is what you're looking at. It is all TradingView. I made it to look like that because it's just awesome. All right. Sorry, I'm gonna have to keep looking into my other monitor in case somebody wants to join. I don't want to go there again. So it's very frustrating. I hate when technology just does not cooperate. Anyway, so this is an amazing tool, and hopefully the first part of this video is going to be all about this, but not because I'm trying to shield the product, although a little bit I am, because this is the best forecasting model I've ever seen, and I've worked with some of the best forecasters in the world, and they don't have this. They don't have anything that is remotely like this, and their stuff is good. So imagine this is very exciting for me to roll this out. And again, once I developed it for myself, I realized, hey, this looks like something other people could use. And I find myself using it more and more. This is where we're starting here. I just find myself using it more and more because we went from, or I personally went from having some macro tools and some planetary tools to look at Bitcoin mainly and tried and failed with gold to now. I mean, I was doing Nintendo yesterday because I had a podcast with Margot Amala. Some of you know her, and she asked me about Nintendo, and I was like, hey, I can spin up Nintendo forecast in 5 minutes, and it did. It took me 5 minutes. And yeah, ask me about Nintendo later if you want. Apparently, there's a big low coming there because she said she suspected that, and this takes away a lot of the any of you Astro traders out there. It's very involved to try and find which combination of celestial body movement actually correlates with your market of choice. Like it's easy if you're looking at the stock market, you have because everybody's looking at it and there's some work done there and you have some of the work cut out for you. Sometimes you can make sense out of like things like Bitcoin. I know Ina, I think you like to use Venus and Uranus, I think, which makes a lot of sense. It's like technology disruption, but also money. But BYD, Xiaomi, these Chinese tech companies that I'm invested in, like I don't know. Um, and I can figure it out, but it would take forever. The Astro framework that I developed, which you can actually see down here, um, it worked. This is the aspects model, which I call a volatility model now, because based on and I have some papers if you want to read them about the testing and how they work. Based on my testing, these aspect models predict volatility, not necessarily turning point, although they can predict turning points at times, but it's really a volatility model. So I demoted it to a volatility model. I could only get it to work on Bitcoin. So the framework was there. It worked on Bitcoin. Try to use it gold, and it was hit and miss. Partly because it is a volatility model, and typically that's what it will forecast. It will not forecast turning points. You look at it on TradFi, uh, it will work reliably as a predictor of increases or decreases in volatility. It's not going to work so well if you just want the actual turning points, and especially didn't work so well if I wanted to have like, hey, I don't want just some random prediction about a turning point. I want to know when the 2-year high is taking place. I want to know when the 2-year high is taking place, and I don't need 50 different dates every year because a 2-year cycle tops out every 2 years and it makes a low every 2 years. So if every year I'm having 50 forecasts, not great. Volatility, acceptable. But yeah. And so developed it and started using it more and more just to get a sense of where things are going. Now, why am I starting with the treasury market here? And why am I starting with this cycle? Well, the reason I'm starting with this cycle is because it is the most accurate for the bond market. And I find it extremely useful for predicting interest rates. My interest in the bond market has to do with interest rates. I don't trade bonds. I used to when I traded TradFi, but I don't trade them anymore. I don't find them, they're not crazy enough for me. I'm a crypto trader now. So I need volatility. Now, just want to zero in on what this 2-year wave is. It a 2-year wave? It's actually an 18-month wave, but now that I'm using planets to forecast cycles, I don't even care what the duration is, guys. Like I can forecast a cycle that will vary in time, and it doesn't matter because planetary orbits vary, so does the cycle. And we can predict it quite reliably now with these tools. Now, without further ado, why am I talking about bonds? Because stock market is down today. The crypto market is completely retraced the moves from yesterday, today. This week at Weiss, for those of you who follow me there, I wrote about how, hey, the Fed is lagging the treasury market now because the treasury market has been selling off for quite some time already, a few months, and nobody is. There we go, more people joining. And nobody seems to be paying attention, and the Fed is stuck. So the Fed is no longer. So the Fed was expected to cut rates. Now it seems like they're lagging. I'm going to show you a bit later the chart. I mean, this came from Camel Finance. Some of you know him. Camel is the one actually who taught this to me, not me directly. He posted a YouTube video on it. The Fed just follows the 2-year rate with varying degrees of lag. Usually they lag by a few months, which means if the 2-year rate begins to go up, a couple months later, you're going to see the Fed hike rates. The 2-year rate begins to go down. A couple months later, you're going to see the Fed start to cut rates. So that takes away all of the mysticism about, oh, what is the Fed going to do? The Fed will just follow the 2-year rate. Now, that gets back into this bond forecast this 18-month wave, because according to this forecasting model, the planetary model, the 10-year rate, which it correlates not perfectly, but it does correlate with the 2-year rate, and the 10-year rate, which is what you're looking at here, is supposed to make a low. This is the treasury market, so they're inverted, and treasuries were supposed to make a low around October of last year, and notice that they have. And this actually only runs until mid-March of 2026. Treasuries have continued to sell off. So this wave is playing out, is predicting what the price of treasuries and the 10-year rate is doing quite reliably. And what it says is rates will continue to go up until August of 2026. That means why would rates be going up now? Oh, Strait of Hormuz, the Iran situation, oil is going up. I was looking at a chart of CPI yesterday, and it correlates very well with the price of oil. And as oil trades above $100, and that's WTI, West Texas Intermediate, Brent is higher. If you buy oil in the Middle East, it's even higher than that because that's where all the disruptions are. And so oil is heading higher, inflation is coming back, and the bond market is starting to price that in. Now, do we have a sense, or could we predict that move that we're seeing now in the interest rate market? 100%. You can see it right here. I don't know if this is, silver has dumped too. Actually, Perry, that's a great point, because I think the reason metals are surging has everything to do with inflation expectations. So inflation expectations are going up, and that's affecting everything. and I believe it will start affecting crypto and specifically the stock market more and more, because the stock market, which is any of you who has been trading for a while, you will know that there's this perception, and I believe it is very true, that the bond market is smarter than the stock market, which means that honestly, I don't think that's true, but there's some truth to it. There's some truth to it in the sense that the bond market will react to real macro developments faster and more accurately than the stock market. The stock market usually lags behind. So, for instance, the stock market has, in my opinion, now that we know what stock market investors think, although I've seen some videos from macro heads who are totally dismissing the situation in the Strait of Hormuz, saying doesn't matter, IPOs, Anthropic is at 1.2 trillion in market cap, and SpaceX will IPO at some point within the next few months. Who cares about oil? Who cares about the macro situation? Macro situation looks horrid right now. But bonds did not ignore and never ignored the situation in the Strait of Hormuz. And if you were watching the bond market, as it becomes clear that this gridlock we're in, or the world is in right now in the Middle East, as that situation prolongs and prolongs itself, and there's no resolution in sight, inflationary expectations begin to climb higher. And this week we got inflation readings way above expectations on PPI and CPI in the US. So bonds are pricing that in, meaning interest rates are going up. We have a sense here using this model of how long interest rates are going to go up for. And apparently it's going to be until August of 2026. And you can see that there is some variation here. Sometimes the cycle is going to turn later than the actual price of the treasury market. Sometimes it will line up exactly. That's just how it is. And you're going to see that all these forecasts, that's kind of how they work. For instance, notice here that, yes, it is true, we have a peak here around October, but bonds try to sell off. Sorry, they try to rally. So interest rates try to come down sometime in August of 2026. The way you get that is if you look at the shorter term cycles, like the 80-day cycle or the 160-day cycle in the treasury market, you're going to see these spikes. But what I've learned to do, since I've been using this tool for a couple of months now, is to just look at the long-term waves. If you're not going to trade this market, you don't care about a 160-day cycle, 20-day or 80 days. You don't care about those. You just want to have the outlook. And this is where I find this tool extremely useful. It's like, what is the outlook for the treasury market? Well, the outlook is for rates to rise. All right. So rates, they'll continue to go up. And that's important because if rates go up, that tends to be bearish for Bitcoin, at least in the within 13 months, but it can affect it right away if you drill into the reason why rates are going up. Rates are going up because inflation expectations are going up. And if we look at oil, my favorite cycle for oil is this one. And I believe it's on the individual view. And yes, this is still work in progress. I'm not sure I'm going to keep all these views. There's too many of them. But this is the view from the oil market. And this is the 8-month cycle in the case of oil. And what we're seeing here is something quite similar. So in the treasury market, we have that from October of last year until August. So call it between July and, I don't know, September of this year, rates will continue to rise. Well, the reason rates are rising has everything to do with rising inflation expectations, and that has everything to do with oil. So next, we look at oil. And what is oil doing? So according to this 8-month wave, which is it's quite significant in oil, I'm not going to go through the whole thing because it would take too long. But notice that this 8-month wave turned higher in January of 2026. We have an actual low, the actual exact low was about a month earlier. That's fine. That is well within the margin of error. And it's supposed to turn up. And then where we're at now is this lull between this high here in March of 2026. And I'll show you in the charts later. March of 2026, March 10, is the actual high in the oil market so far. That's when oil topped out. I believe it was on the 11th. It opened up, I think it was a Monday, and it opened up way up $120 on WTI, and then it crashed below 100 on the same trading session. And there were allegations that the U.S. Treasury was intervening in the oil market. That was the allegation. So it was a very dramatic event. It may have passed unnoticed because there was so much volatility in the oil market that, yeah, that was not maybe didn't catch your guys' eye, but that was actually the top. This is when oil topped out in this latest surge. It was March 10 or March 11. It was somewhere around that time. So that's the intraday high. And so it is behaving somewhat according to this forecast. And again, it's not exactly the same, but it will follow these forecasts uh, quite remarkably. So it's a very useful tool. And what it's saying is, okay, so we have the high in March, and notice that the wave now, which turns sharply higher here, and then it turns like somewhat sideways, it turns down, but not aggressively lower. And these bottles are so powerful that if it turns up sharply like this, you might expect the market to turn up sharply also. And if it's turning down slightly like this, you would expect the market to turn down slightly also. So it's not just it's it's very high correlation to the actual underlying market that it is trying to forecast. This is the norm, not the exception, which is why I love this model. It's very powerful. What it's saying is, well, this lull we're in is supposed to end right around now. Now it says May 13th for the bottom, but notice that this can be off by a few weeks. So it doesn't mean it's going to end now, although I think it will. This lull that oil has been in. So we have treasury market going down, rates going up as a consequence, and we have oil that has been somewhat consolidating in a highly volatile range right up until now. So I believe the next phase of the oil rally starts now. Now, if you remember, the treasury market is supposed to make a low in August. The oil market, according to this particular cycle, there are others, but I'm not going to go through them. It's just, it doesn't make the point I'm trying to make. Suffice to say, none of it contradicts. Like the longer term cycles on oil do not contradict what I'm saying here. In fact, they're all marking a top, but they're saying the top is somewhere this year, which I think makes sense. What this means, I believe, for long-term oil cycles is that there will be some resolution to this Hormuz situation at some point, but not right now, which is why I'm zeroing in on this particular cycle, because this is the one that has been highlighting what's been happening. And so after this lull ends, which I think it has ended already, oil is supposed to go up again, not as aggressively, but it's probably going to start climbing higher again as we head into a high sometime in July. So we do have some. We got more people joining. There we go. See, you see, this needs to be taken care of. Anyways, so we do have this lull in the oil market that is ending now. And it's going to start, according to the forecast, it should start to rally going into a high sometime in July. And that sort of lines up with the bond market because they don't have to line up exactly, guys. And actually, it's a feature I'm going to build soon. It's my favorite word nowadays. But I'm going to build a feature where you're going to be able to see the cross-asset correlation between certain turning points. So you can kind of do this assessment that I'm doing now by looking at multiple assets and what they're saying. So with this and some semblance of an understanding of what's happening in the world, you can look at the treasury market, the oil market, the stock market, the crypto market, and get a sense of when all these dates are lining up and when are they contradicting each other. And remarkably so, right now, none of these markets are contradicting one another. They're all saying the same thing. They're all saying treasuries, they're supposed to drop into, let's say, the second half of the year. So is oil. Oil is supposed to go up as we head into the second half of the year. Rate hike expectations are extremely high right now. I think, in fact, the Fed is expected to hike rates at least once this year. This is all lining up. And I believe it's on the back of a rising oil market, strengthening oil market. And why would that happen? Well, because in spite of the stock market posting like one of the strongest macro rallies in the history or whatever, or at least for the past, at least since 2017, which actually I want to go over that because it reminds me a lot of late 2017, what we're seeing now in the stock market. And in spite of that, this situation in Hormuz is not being resolved. And the AI narrative is great, but if energy is more expensive because the oil market is more expensive, AI is more expensive. Like it would even slam the brakes on that AI rally. And I'm not an AI bear, and I'm not saying there's nothing to that. I'm just saying looks like the stock market is a little ahead of itself, and it's completely ignoring a bearish macro situation. And we have supply shock disrupt. That's supply chain disruptions that they're not the same, but they resemble COVID. That's how bad they are. And the market is partying like it's 1999. It makes no sense. And if you look at these forecasts, you can see why I have been somewhat concerned. It's not just negative liquidity outlook, which you all know about that, and we're gonna review it again today here. But it's not just that; it's I'm looking at these models, and they're all sort of lining up. So just to summarize, we have the Treasury market, just for those of you who just joined, of a Treasury market that says rates will continue to rise into August of this year. Then we look at the oil market, and it agrees because the reason why the Treasury market is likely to go down for a few more months has everything to do with oil. And sorry, I need to switch back into this view. Has to do with oil ending this consolidation that you could argue started sometime in mid-March. It's about to end now, if it hasn't already, and we have another leg higher in the oil market. So it lines up perfectly. The last thing before we dive straight into crypto is the stock market. And the stock market looks bullish still. However, it is also starting, according to this framework, a correction. And the correction is starting, let's see, when does it say this? I'm going to go to the individual view because it's a bit more clear. So we had the rally in line with what this model expected. So March 17, what is it? March 16 is the low. The actual low is a couple of weeks later on March 30th. That's fine. That's well within the margin of error. And then it's supposed to rally into a high sometime in late May. So according to this, it's May 31st. In fact, the most prominent turning points on this tool will be highlighted with a date. So you can see when that's supposed to take place. It's supposed to take place around May 31st. Subtract a couple of weeks, and that's right now. And remember, a couple of weeks is the margin of error on this particular model. I just showed you that. It's about 12% plus minus of the cycle duration. So if you want to get a sense of what is the margin of error, it's about 12% of the cycle duration. So a couple of weeks in this case. And it's supposed to top out sometime in May. So let's see. Rates are supposed to rise into August. Oil is ending this consolidation and it's starting to rise again. And the stock market is nearing a peak. It's nearing a peak that is in the, let's say, the second half of May. It could extend into June also. That is within the orb of this particular cycle. But since oil is saying it's putting the date more in mid-May, crypto's putting the date more around mid-May also, I'm leaning toward this idea that, yeah, the stock market may have a little bit of fuel left, but as oil turns up, as crypto turns down, so too will the stock market. And no, I'm not predicting a crash. The rally has been so strong that maybe the next down move is fierce, but I will not short it. Definitely not short it. And it may be a buying opportunity. We'll see. Maybe we can assess that together in this session. So finally, we're going to Bitcoin. So remember, we have bullish, bearish, bullish for interest rates, bullish for oil. These two are related. That has to do with rising inflation expectations and rising rates. We have a bearish stock market outlook. And then you already know, because I showed you a billion times, but you already know the outlook for Bitcoin is the same. So we have a high for Bitcoin on May 13th. May 13th, a couple of days ago, that is a high in Bitcoin. This is all lining up. In fact, May 13th is the exact same date that we had in the oil market. So you see, again, this is within the margin of error, but we have bullish oil, bullish rates, bearish stocks, bearish crypto. These things do actually move together. So it actually makes sense to see all of these things lining up. And you can see them on this framework. So hopefully you enjoy that brief presentation. If you want me to go back and review something else, I can, but that's the outlook that we have right now. We have rising oil, rising rates, bearish for crypto, bearish for stocks. And I think we're starting this correction. We're starting this leg down again. And to be honest, I haven't even looked at the crypto market this far. I haven't looked at markets at all. I was at the gym, quick breakfast, and I came here. So I haven't seen any charts. I loaded up my trading view, but I wanted to start here just to make the case that we're about to see a turn across all of macro. And it's all lining up with this tool that I'm creating, which, yeah, you're going to be able to use it soon. I'm just rolling it out slowly. I know some of you have access to it already. Hopefully at the next AMA, I'm going to open access to everybody. And I want feedback. I just want feedback from all of you guys, because I'm trying to make the best tool, best forecast. This is what I'm trying to build. Best forecasting model the world has ever seen. That's what I'm trying to build. And I think I have the tools to do so. Anyways, before I dive into the charts, let me just go through your comments. Silver has dumped over the past 2 days. I think I read that, Perry. And yeah, I saw that. I saw that gold was going down. The Chinese stock market was also going down. Interestingly enough, the Chinese stock market is probably at a low. Let's see if we can get that. I haven't looked at this at all. Some of these models I have to get rid of, to be honest. I mean, just complete garbage. Um, what is the outlook for the Chinese stock market? You know what? Let's not get sidetracked there. Nobody yet. If you want, I can look at that. But I think I remember it was at a low because this model is inverted, and then it says June. Chinese stock market does not trade with high correlation to the rest of the world. It's kind of different in my experience. So I think it was at a low, but I can't find the reason why. I think the Chinese EV makers are close to bottoms. Um, I own those. I don't trade them. I just own them. So the way I use this model for investing is quite simple. If I see that we're getting close to a multi-year cycle low, I just buy. It's easy. What does your forecast say about silver? It's bearish, Perry. It's bearish, but I haven't done silver specifically. I've only done gold. Um, and you can see that like the long-term gold models are they're quite bearish. And I notice this one, for instance. Look at this wave. This wave is very reliable in predicting this multi-year cycle. I think this is a 3-year cycle on gold. It's quite reliable. And again, it can be slightly off at times. Notice that it said that the cycle had turned. And by the way, once you get acquainted with the tool, you're going to see that with the long-term cycles, this is very common where you're going to see the forecast turn. Let me turn this off. By the way, you have several views. If you don't like these things, you can turn them off and you just look at price and when the big bottoms and big tops are going to take place. Personally, I like to view it this way with turns turned on. So it's these vertical lines. Then you see the raw price. This is the latest edition. And then you see the forecasting model because the forecasting model will at times produce, tell you, give you a sense of what the market is going to be doing, even though if it's not exactly correct. So notice that this cycle turned higher on 2014, but I know this low is in December of 2015. But gold decelerated from its relentless sell-off. It went sort of sideways into a bottom. And once again, you can see those other bottoms, other secondary bottoms, if you break down this 3-year wave into subcomponents. I personally don't do that because I'm only interested in the long-term outlook for gold. And the long-term outlook for gold, just showing you here how accurate this particular model is. And it turned again. And just like in what is it? Just like in 2014, it turned in 2014 and the actual low is in 2015, even though it was a kind of like a sideways consolidation period following this turn. I'm expecting the same thing here. I'm not saying maybe it can rally to a new high. Personally, I don't think so. You know why? I've been saying this for months. When a market goes parabolic and then it crashes by the most in history or the most in many decades, which is what gold did in January, that usually means that's the top. So the way I'm reading these, or the way I'm personally starting to read these long-term cycles is just because a long-term wave is turning down does not necessarily mean that the market will turn down exactly on that date. Sometimes it will, like you can see here, that it pretty much did turn almost exactly when it said it would. Sometimes it doesn't. Sometimes it takes a while because other cycles are still pointing higher. So they're not actually lined up at the top, which is something Hurst talked about. He said that the tops are not aligned. It's the bottoms that tend to be lined up. Although in my experience, none of that is true. Like these cycles can be off face at times, and you can pick it up with this tool. And so oil continued to go higher. Gold continued to go higher. Just because this wave turned doesn't necessarily mean that it's going to turn right away, but you need to be on the lookout for a big turning point because this model is very accurate and it can be early at times, but it's rarely just wrong. In other words, oil, they keep calling it oil. Gold just keeps going higher, completely ignoring what this wave is saying. Of course it can happen, but that's not as likely as as the market just lagging by a few months. In this case, it lagged by quite some time, over a year. That's okay. That's normal. I've seen that before studying this wave. And this wave is turning down. And so gold will turn down. At the very least, it's not going to do great. And I think we can make the case as to why that is, because we're already seeing that as inflation expectations rise, as rate high expectations rise, as the bond market sells off, so too does gold. Because when rates go up, people don't want to own gold. And I think that's what we're seeing. Not predicting a crash again. This is a 3 year wave. I do believe that the longer term, like the 7 year cycle, is also turning. Yes, it is. But this cycle, I will say, is not as accurate. So I don't rely on this one so much. It looks accurate here. You can see all the shiny numbers, 88% correlation. But I actually did something called as a walk forward test, which means you're slicing the data and then you're seeing whether the model is robust. And this one did not pass the test. So this model is not robust. This one is though. The 3 year wave is robust. When this one turns down, I pay attention. This one turns down, I'm not dismissing it because I think I said Perry before I even had this. Before I even had this tool, I said, "Hey, gold is trading like it's gonna make a 14-year cycle top." That's what the price action looks like to me. The last time gold traded the way it's trading now, it was in August of 2011. That is the last 14-year cycle top. And we're somewhere in that area now. Notice that that was 15 years ago. 15 years ago, gold made. I can't call it gold. I just can't call. I can call it oil. I can call it Bitcoin, but for some reason, I can't call it gold. Anyways, so 15 years ago, we had the last 14-year cycle high in gold. Uh, and in commodities, you can actually count cycles from top to top, which is this thing here on the tool. It's in, I think I have it here, inv gold. So you can invert it. And with commodities, I do this. I'm starting to create this framework where I not only forecast the commodity itself, but I flip it and then I forecast that too. Suffice to say, they say the same thing. These models are pointing to a not just a 3 year cycle top, a multi-year cycle top, potentially a 14-year cycle high. Now, why am I somewhat dismissing this? Other than the walk forward test, in other words, this model is not robust. This 14-year cycle model is not robust. Other than that, the fundamentals and the macro situation we're in now, I don't think support a bearish gold market. I don't think, because notice this model is saying, oh, this just continues to go down into 2031. And that's only because I only forecast into 2031. So I don't see that. I don't think that's gonna be the case. But I am leaning on this. This I do believe, a multi-month correction. I think we're seeing it now. And the low, according to this wave, and again, this model is robust. Robust means it's good. Like if you can punch, you can poke holes at it and it will still hold it together. That's what robust means. It means it works. It means this is not a fluke. Or somebody told me recently, it's not uh what is it? Spurious correlation. That's not what this is. This is very robust. Uh, I don't do these walk forward tests with every prediction, every forecast model because it takes hours to run on a single asset. It's just like 3 hours to do on a single asset. So it takes a very long time. I did it with stocks, I did it with Bitcoin, I did it with gold, and they passed. But with gold, the long-term stuff with gold was not. You can clearly see when you click on these, it's like they're not. It's like, okay, sure. There's something to it, but they're not robust. I'm gonna clean those up, by the way. When I figure out what needs to be cleaned out, like what to look for as a red flag, I'm just gonna clean out those models. But yeah, the outlook is bearish. It continues to be bearish. And if rates continue to go up, if the Fed begins to hike rates, and if the Strait of Hormuz situation is not solved, I think we have a reason why gold may be bearish now. Whereas we didn't really have that in January. In January, it's like purely based on price action, markets going parabolic. In fact, those of you who know of Ray Merriman, I met Ray, probably doesn't remember this, but I met him for the first time in June of 2012. And at that point, anybody who was trading FX at that time, the Swiss franc was going parabolic. And I remember Ray was giving this presentation about the Swiss franc, and he was like, he was more cautious about, he was bearish on the Swiss franc, but he was cautious on the outlook. And I remember I was just starting to trade. I've been trading for like 3 years, but I was already fascinating with charts and just looking for patterns. I was fascinated by this. And I remember raising my hand and saying, it's going parabolic. And when a market goes parabolic, it tends to crash. That's what they do. And so that is actually one of the most reliable patterns. I think not one of the most reliable pattern in financial markets is if something goes parabolic, it crashes. And you can dismiss the fundamentals at that point. So the reason I was cautious on gold had to do with how it was trading. I was already aware that it's been 15 years since the last 14-year cycle top. But then I created this framework and it confirms it. Um, in fact, I will show you this one. This one is pretty good. I like this one. This is a 360-week cycle. And since I'm bad at math when I'm doing recordings, I'm just going to do the following. How many years is that? Oh, that's 7 years. So that is a 7-year cycle in gold on a weekly chart. This one I haven't tried to punch holes on this one, so I don't know if it's super robust, but it is pretty good. It fits the price action pretty well. Um, and it's saying the same thing. Top December 2025. And notice how it begins to like this shouldn't do this, but it is. It's kind of like showing a distribution pattern, but then from this point, November 2025 forward, it definitely turns down. It just convincingly says, nope, now you're turning down. Now you're heading lower. I think inverse gold shows the same thing, just briefly. There are different cycles when you flip the correlations, but notice that we have a forecast for a high in May of 2026, for instance. So this one gives you a bit more resolution. In fact, if you flip gold, and what that means is you should not look at the value of an ounce of gold in dollars. You should look at the value of how many ounces of gold is a dollar. That's what it means. It means that that's how you should look at gold. In fact, so gold is the base currency, and the dollar is a layer on top of gold as the main currency. If you look at it that way, the planets actually speak louder, but they say the same thing. It doesn't change. This long-term cycle, this is what is this? About a couple of years, turned down September 2024, somewhat lining up with when we flip this thing, somewhat lines up. And then it says it's supposed to take like a pause between December and May, and then it continues to head lower. That is kind of what we're seeing. That is kind of what we're seeing. So they say the same thing. This one says the low is in June of 2027. I don't know when this cycle turns. Oh, let's see. When does it turn? March of 2027. So yeah, and these things vary by a few months. These are multi-year cycles. So same outlook, same outlook. Not buying here, personally. I am gonna buy as an investor. I just want to own gold, but much lower prices is what I'm expecting. And then I'll start to accumulate because according to this, at least the 3-year cycle turns higher between 2027 March 2029. I'll take that. That's a couple of years of going up on probably the most robust gold cycle forecast that I have. So let's just keep going. So maybe there was a longer cycle of gold, continuing to push it. Bitcoin Gold coin, yeah. Perry, yeah, that's exactly what it is. Like again, you can spend hours on this, and I have. I don't want to go there, but yeah, if you look at the subcomponents, especially this subcomponent, you can see gold continuing to push higher. Like you can see these. For instance, look at this. This cycle is also quite reliable on gold. This is a 160-day cycle. That's about 6 months. This is the 20-week cycle, by the way, that I teach on the course for those of you who watched it. By the way, guys, let me know if you want the raw files of the course to be on YouTube. I have been holding on to those because not enough people are watching, and they're raw. It's like raw footage, but the lessons are there. Not all of them are. I'm not proud of all these lessons. I would redo Bitcoin entirely, but the gold lesson was amazing. I think it was the best ever that I made. I made some forecasts there. They proved exactly correct. The prices, everything that was there, still relevant today. And notice, Perry, for instance, this is just a brief overview of how you use this thing. You look at your 3-year forecast, very robust model. That's what this purple icon means. It means it's quite robust. You can skip this one if you want, and then you go into the 20-week cycle and look. It says top. There's a top here in April. There was a top in April. Then there's a low sometime in August. There was a low in August. You can see how the price action overlays on top of the forecast, and then the high. The actual high is March of 2026. That sort of lines up with the actual high and go. The high was in January, but I do believe there is a secondary high in March. And then it continues to go down until when? Look, February 2027. And then a rally into August 2027. So like it looks like 2027. So next year is when gold will actually turn. It's not going to turn now. That's what this is saying. And I've been looking at gold for a while. because I do think it's in a multi, even beyond the 14-year cycle. I think it's in a massive bull market, and I would not stop buying gold until it re-enters the monetary system in some official form, like maybe China and the US settle trade in gold for something like they already are. The Chinese are recycling those dollars into gold. They're not buying treasuries anymore. But I want to see some type of event. Maybe the Gulf nations begin to bring gold into the forefront in some capacity. Like I want to see the dethroning of the dollar, and that would be my fundamental reason why maybe gold has is done for now because it's been reintroduced formally into the monetary system. That's been my expectation since 2010, and I think we're seeing it, which is why I'm just looking for bottoms in the gold market, just looking for bottoms, just looking for buying opportunities. But according to these models, it's gonna be in 2027. I, Gold doesn't necessarily have to follow the orange line, by the way. It doesn't have to crash. The implied sell-off here, I believe, is I can't see it yet. I just added this feature. Oh, can we see it? No, we cannot see it. No, actually we can. So the implied sell-off is going down into 3,400. But this model is not great at predicting price. It tells you about time, a lot about time, but not a lot about price. But it's still gonna be consolidating. So okay, let's move on. So bonds are ahead of every market, smarter or not. Maybe bond drives a lot of it too. Bonds forecast Bitcoin by 13 months. Yeah, 13 months. And I actually tested um every week from week 0 out 2 years. And the most reliable bond forecast for Bitcoin, so they reliably predict Bitcoin 13 months ahead of time. So bonds, yeah, bonds are the bedrock of the financial system. And yeah, they are the smartest market. So the smartest money trades bonds. There is a saying actually, like gentlemen trade bonds or something like that. There's like a saying people say. So yeah, bonds. I don't trade them because there's extremely low volatility, uh, which makes them uninteresting to me. But you should always be aware of what the bonds are saying. If bonds are selling off and the stock market is ripping, red flag. That is a red flag because the bond market, which is smarter than the stock market, is saying, hey, there are problems. There are problems. I just read this morning that the UK gilt market is, I don't know if it's a 30-year, maybe it was a 30-year, uh, highest level since 1998, the interest rate. Like the UK is just tanking partly because of Brexit, partly, but it's Brexit, but it's the inflation shock, and they're just not able to deal with it so well because they decided to isolate themselves. But it's the same problem we're seeing everywhere else. And the gilt market, if you remember, was the canary in the gold mine. Coal mine, is it gold mine or coal mine? I think it's coal mine. So the canary in the coal mine was the gilt market back in 2022, and we're heading for a similar low. Actually, I haven't checked that, but let's see. Let's go to the treasury market again. I like this. Um, let's see. So this is the 18-month. Am I in treasuries? Yeah, treasuries. What is it? 2022, 2022, 2022. Oh, there we go. So 2022 bottom. Yeah, we are headed for a similar low. So we had a few of these important lows in the treasury market, but we're headed for another one of those. And you can already see the gilt market puking. So yeah, it's not looking great. Can you please explain how the orange, blue, and gray lines are calculated? Ooh, that's going to require its own AMA. So the blue line, I'll do the blue line first. This is the isolated frequency of the 18-month cycle. So let me just hide this. Look, it's the isolated frequency. So what this is what the 18-month wave is doing in this case. And if I switch to this, now you're looking at the 20-week cycle. You have to isolate, and it's not my methods for isolating these are not perfect. You can see that sometimes there's like a little bit of noise that filters through, but they're good enough. And actually, if you want to reproduce this work, you need to isolate the frequency, and the better you are at doing that, the better your forecast will be. So I'm just doing it by taking one frequency and subtracting another. It's pretty simple, and you isolate the wave. Then you get this. What this is once I have the isolated frequency, I fit it using the orange line. So I fit it using my algorithms. I find the combination of planetary movements that will best fit the blue line. So these two are tightly correlated, which is why the first version of this app did not have price. It just had the blue line, because the blue line is the price that I'm fitting to is the blue line. I'm not using this at all. I'm ignoring this. This is noise. It's too noisy. You need this. You need to isolate the frequency. Once you have, you can fit. So these two are tightly correlated. The blue line is the trainer, and I'm training the model on that blue line to produce the orange line. And then this is just price. This is just price. But to be honest, once you have price, once you have the orange line, you can get rid of the blue line. You don't need it. You can just look at this to see how it, shapes out, how it actually correlates with price action. So that's I hope that explains it. Um, I think the US price of oil is always highest in the summer in order to capture people traveling 4th of July. Here's how your tool shows it in past year. We can look at that. I recommend we don't. So expensive fuel all in 2026. But macro events still overpower the cycle energies, correct? Uh, Oil is a global commodity. So I don't know about the seasonality of fuel in the United States, but I think that this, so far, what I am seeing is that the 8 month, which I think is a Venus cycle. Let's see, is it? Oh no, it uses 80 features. It's not Venus. So this market is reacting to the geopolitical situation. I don't think it's seasonality at all. I read yesterday that apparently Bibi Netanyahu is preparing for maximum strikes, whatever that means, on Iran as soon as Trump is back home to Washington. So uh, apparently war is starting again. Not calling for that necessarily. I don't have any insight on that. I have been expecting the war to start again, but it hasn't. I've been wrong about that. So I don't know. Um, but according to this forecast, the reason why you would see oil rally may have something to do, like the seasonality of it makes a lot of sense, Barry. Like, yeah, everybody's traveling to Europe now from the Americas, myself included. I'm going to be traveling in a few weeks. Um, so everybody travels to Europe. Airline tickets tend to go up. That should push up the price of jet fuel, oil derivatives, 100%. Um, but also we have the situation in Iran, and I think that's the biggest factor, because you don't see surges like this in the past. Like you can go back, and you just don't see them. Like the last one was in 2022, right here, and this is the last time we had an energy shock. And I was in Europe, living in Europe at the time in 2022, and that energy shock was real and it was painful. And now, and you notice that I actually before I had price, I only had this, and I didn't think the orange line, so the planets were doing a good job of predicting oil. But then when I actually overlaid on top the price, I realized, oh no, this is very good actually. It's pretty good. There's a lot of unseen spikes here, but overall, the shape of the curve, the when the model says the big lows are gonna be, yeah, you do find those meaningful lows. Sometimes it's secondary, like this is the biggest low. It's right here in December 2022, but the actual low is on a secondary bottom, right? So they diverge. Could argue that's a buying opportunity. So it's pretty good for oil, actually. I thought it wasn't, but it actually is pretty good. Macro events still over power cycle energies. So all right, so let's go into the rough the price section. Let's go in my classic charts. Let's see what those are saying, because I haven't looked at them. So the outlook, it's quite bearish. And let's see what's happening today. So let's start with Bitcoin. All right, so Bitcoin has completely undone the rally from yesterday. So we've seen the planets, you know what the outlook is, but that is entirely based on planetary motion. Now let's see what macro is saying. So again, let's start here with a weekly chart of 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 Bitcoin, because they're lining up again, guys. I'm not making this up. I'm not, because we've been looking at this forever. So we're looking at this. Let's copy this line. Boom, boom. And macro is saying the same thing that Bitcoin appears to be doing. And so we've been looking at this February bottom since last year. We've been talking about a Q4 correction since Q4 of last year. We were expecting a sell-off into February, so I called it a Q1 bottom because I wasn't sure if it was going to be in February or March or January. I personally actually started buying Bitcoin in late January because we was very close to this to these dates, these February dates. But it was we were expecting this. So we expected the rally. It was nowhere near as strong as I personally expected. I thought Bitcoin was might go to 90K or 100K because that's what liquidity said. That's what the bond market suggested. But no, we had the war. We have this. This is what I'm landing on right now. What happened here is look at the orange line, which is Bitcoin, versus the other two lines, and what you see is this: the second half of March was bearish. Now, I know the Japanese M2 shows this correction, but there is an alternative interpretation. The alternative interpretation is that the second half of March, it is the thick of the Iran war. It is when it got worst. Because up until the first half of March, the market was all too willing to dismiss what was happening in the Middle East. They dismissed it as this is Venezuela, right? This won't last long. It will be solved very quickly. Apparently, the market is not good at geopolitics, unfortunately. So that's what the market expected: quick resolution. In fact, going into this high in mid-March, I believe this is when Trump was saying, "Oh, let's just use the U.S. Navy to patrol the Strait of Hormuz, and it will be fine." And the market believed that. in the in the second around March 17th, I believe the Navy itself came out and said, "That's not happening. We're not going to do that. We can't actually do it. We're not going to risk our ship. Like this is a stupid idea." I'm paraphrasing. I wasn't there. All right, I don't know exactly how those conversations went, but basically the idea is around March 17, it became clear that oh, there is no quick resolution to this. We're fucked. We're in a bad situation. That's the second half of March. And so we have the sell-off here that does not show up in the macro models. A 2-week deviation, which yeah, there I've seen plenty of those. I've seen plenty of those. When Trump was shot, 2-week deviation from liquidity and from macro. When the Genius Act was passed, 2-week deviation from macro. I believe that we may even see a very bullish crypto market around the time that the market begins to price in Clarity Act passing. I do believe that's going to be a bullish catalyst because Genius was a bullish catalyst. And so you might see divergences from the ideal liquidity picture around these key pivotal times. And I do believe that the Iran war was one such time. However, Baron, that's like, ignoring that, Bitcoin has been moving alongside the macro. And so what is the macro saying? And this was fascinating to me. I don't know if this was fascinating to you guys or not. Those of you who were paying attention, we were watching for late April, early May top. It was showing up in the bond market 13 months ahead of time. That's how early we could see this. And lo and behold, you saw this liquidity line. Let me change these. Let me make these blue. Uh, oh no, that's the text. So we make these blue. So liquidity was rallying up into the same top, somewhere around the same. So within a week, liquidity does the same thing and begins to head lower, following the bond market. Not only that, it actually already established this important low again a week ahead of the bond market. So it topped out, liquidity tops out a week later than the bond market, and it makes a low a week ahead of the bond market. And look at Bitcoin. Bitcoin is topping out exactly alongside liquidity if this high holds, which I believe it will. I think it holds. Yesterday, it was confirmed that the Clarity Act is headed for a Senate vote. And I said on Discord, you guys saw that. Okay, it's now or never. This is the only chance Bitcoin has of ignoring the bearish liquidity outlook and the bearish planetary models. It can't ignore all of that if people get so bullish about this Clarity Act that they just buy it regardless. Well, that came and went. We took out, I think we're taking out the lows. We're not taking out the lows. There's still a chance. There's still a chance. We can discuss that in a minute. But I will,
Juan, I have a question on that.
yeah,
So,
I knew you would. So go ahead, shoot.
yeah, because what is really happening? So, especially yesterday's case, right? You know that I knew it. It's gonna pass, right?
Yeah, yeah.
I think that was already maybe kind of priced in, but let's even kind of ignore Clarity Act here, right? Um, what you just said, your statement, right? Expectation is Clarity Act, gonna pass and people are gonna just come and they're gonna become mega bullish, right?
Mhm.
And they enter into this market. But what is actually happening so far? Retail is totally missing. I mean, retail is nowhere in crypto right now. All this rally that we're seeing, it's only by institution flows. That's it. So, and at this price, given the social media narrative on social media, many cycle traders are kind of, saying it's going to go bearish, and the mindset is, if it goes to 50, that's when I will buy, right?
Mm. Yeah.
So, I mean, I spoke with my partner Alan yesterday, and he even shared the same thing. And this is where we're talking about big money, right?
Yeah.
Kind of people coming and they're saying, nah, I'm not buying. Let it drop and then I will buy at the lower levels, right? But on the other end, institutions are getting more loaded. Like yesterday, like strategy 1.2 billion. So how do you see this scenario? Because this scenario itself is very, very different than what we had in the past. I know I may have asked you earlier too, but I just can't wrap my head around it. It's a very different scenario.
All right. So my answer is it hasn't changed. My answer is all of these tools are pointing to downside, and these tools have predicted both the rallies and the sell-offs very reliably for years. And nothing has changed, in my opinion. Um, Not to be dismissive of institutional flows and what have you, but I've been asked that question for
Mhm.
years now, and my answer has always been the same. Cycles don't change. I've never seen cycles change on any market ever, no matter who's involved in those markets. Like, for instance,
Mhm.
gold. I just gave a pretty bearish outlook on gold. China's buying, like they're the largest. Central banks are buying. Nobody wants to touch the treasury market. How can I possibly be bearish on gold? Oh, because these tools are saying gold is going down and it's trading like it wants to go down. So, um, maybe it's I just I don't know how to answer this question better because I see what you're seeing. And by the way, I just want to zoom out here and be very clear. I'm not predicting 50K. I'm not even saying it goes below 70K. I'm not even sure it goes below 70K. I think that if you're shorting this, this they're not really what my framework is suggesting. My framework is suggesting that this is the correction that confirms that the bear market is over. Why am I saying that? Because that's been my expectation all along, looking at the macro. Look, notice that the black line, which looks forward 13 months, is bullish. It says the low is in February and it will not be retested. That's what that line is saying. Now I know these, and I've said this many times, and it's true. These tools do not predict price, but price does tend to follow the shape of what is suggested by these tools. So in other words, if the bond market prediction is sharp low, V bottom in February, and that's it, it's one and done. Usually it's one and done. And so that's the February low. Liquidity only looks forward by 12 weeks, so 3 months. But it's starting to follow back. It's starting to follow the bond market. And if it does follow the bond market, what you're going to see the rally, you're going to see the low sometime in June, and then you're going to see a bottom being established, which it already has. Liquidity has already made this June, July low, and then it's going to rally and it will not make new lows. And if these two do not make new lows, my expectation is Bitcoin does not make new lows. I am not personally selling this. I'm not shorting this. All I'm doing now personally, just maybe that helps answer how I'm looking at this. I'm looking at a cyclical correction, a cyclical downturn, and I'm selling strangles. So right now I'm selling calls because Bitcoin is close to 80K. Bitcoin sells off. I'm starting to sell the 70K put, the 65, 60K put. I don't think it goes below precisely because of this framework. Now there is a chance it goes to 60K again, simply because cyclically that is as low as the Hurst cycle model would allow it to go without turning bearish. And since I don't think the market turns bearish, I would say, according to the cycle theory, it can go as low as 60K, but it can stay as high as it's a very good question actually, because I haven't thought about like downside projections. 65, 66 looks more likely because that will be a higher low. So this 320-day cycle will be doing something like this. Something like this. You see this? We're quite bullish. This is a bullish. It's right translated higher lows, like all the makings of a bullish 320-day cycle wave. So I'm expecting just this downturn that sort of confirms that, yeah, the regime has changed. And to be honest, if we see that, that would be the most shallow bear market in crypto history. It ended with a single low. It ended very early, and it wasn't even retested. So that's the outlook. That is the influence. And you and I discussed this before. That is the influence of all this institutional buying, all this institutional money coming into the market, completely changing how this crypto winter normally shakes out. This is how it changes. That sounds so sad, Panda. I don't know why you're saying that, my friend, but please elaborate on why this is sad. I want lower. Yeah, you're gonna get lower. It's just not gonna get a lot lower. And honestly, guys, I mean, look at this. This is what bonds like. Ignore all of it. The correlation between bonds. I know it sounds shocking when you first hear it because I didn't believe it at first. Like, how can the bond market predict Bitcoin 13 months ahead of time? But it can, and it does. So how do I hide it? Oh, here it is. Liquidity, GLI, go away. Um, 13 months. Now, look at this. Like for 2027, it's giving us a pretty bearish outlook. I'm not even gonna discuss this yet because, like I said, it doesn't predict price, it predicts time. But this is an old correlation. This is very old. It's not new. Look at this. For instance, this is the bond market outlook. Look at the bond market outlook for 2015. It's this, a sideways 2015. This is like prehistory in crypto. Bond market is saying flat 2015, and you knew that in 2014 because it's 13 months ahead of time. And I'm cherry picking a little bit, but this correlation is strong. This is just a very strong example of how strong this correlation is. You overlay Bitcoin and Dub. Oh, look at that. It's almost exactly the same. In fact, in the early days, the bond market was much, much better at predicting Bitcoin than liquidity itself. Liquidity was like, it was hit and miss. I haven't looked at it, so let's look at. You see how it's kind of bullish, and there was a low in April. It's the bond market that actually allowed you to predict. So interest rates have been moving Bitcoin forever, and my expectation is they'll continue to move Bitcoin forever. And just looking at the bond market outlook, and think of it this way: when you're in December of a year, since you can see 13 months ahead of time, you have in December of every year a pretty good roadmap for what Bitcoin is going to do that year. So when you look at the outlook for 2026, the thing that jumped at me is, oh, look, there's a single low, there's a sharp V bottom in February, and that's it. And so far, that's how Bitcoin is trading to me. Like, I don't think 50, even 60K starting to look more and more unrealistic, precisely for what my friend Sandeep said here. All this institutional buying, we have seen the effect. The way I look at institutional buying is it's programmatic buying. So it's like these guys are price immune. They don't care about price. They just buy, 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 buy. So we have examples of what that can do to a crypto market here in BNB. Every month, Binance burns a portion of the supply of BNB by turning their revenue into buybacks of their own shares. They're not shares. Actually, if I was in buyback and Binance and I called it out, I would be in jail. I mean, I'm exaggerating, but you get the point. You're not supposed to call them shares. But there is automated buying, regardless of price, every month for BNB, and that's been going for a very long time. And it shows in BNB. It shows because it has these shallow, like, look at this. Look at this. So this is 2021, and this is the infamous May 2021 low when Bitcoin crashed and everything crashed. And look at BNB. Look at this. And this is fascinating because maybe this helps answer that question. This is what that automated buying, it doesn't negate the cycle, but this is what it makes it look like. It makes it look very different. So this is the May low. BNB never went below. Why did it never go below? Oh, because you have this whale, Binance, that is constantly buying back their own supply. And so this is like one of the few. The other one is Tron, and I looked into this, and Tron also has a buyback program. So the issuer of Tron, Justin Sun, buys back his own supply. And what that does is it negates the bear market. So when every crypto asset was making new lows here, every crypto asset, this is June 2022, every crypto asset that does not have a buyback program was making new lows in June of 2022. And Bitcoin made new lows in November of 2022, but not BNB. BNB stayed in a range, a very volatile range. That is the effect of automated buying on a market. It doesn't change any of the timing. Like the highs and the lows, they're the same. Oh, actually, this is 2023. Altcoins bottom then. Like in November, I'm guessing. Oh, not even new lows in December. This is when Bitcoin made its bear market bottom in November of 22. So you can see how different it is. Actually, maybe I can just bring in Bitcoin here real quick, and you can see the difference. Oh no, there's so many things here. Come on, what are you doing?
I
Mhm.
mean, for strategy, their cost basis is almost 76K, and they're the biggest Bitcoin holders. And for BlackRock, I bet their cost basis is between 82K to 85K. And their aggressive accumulation means they're gonna protect that.
They might
But
protect that, but
it
but the
doesn't
point of
mean that it has to be
yeah,
me. The point is, even if, let's say, it goes to like 73, 75, that doesn't hurt them much. They can buy again more at that price because through,
yeah,
right, they're big gorillas, right? So they can just buy that and that even lower their cost basis, right?
yeah.
But then what that really means, then there is a more supply squeeze, which is right now historically low. The supply squeeze is like hardly 5.3%. That's nothing. We never had the situation in 16 years of Bitcoin history.
Yeah, do
Yeah,
not ignore the growing derivatives market though, because
yeah.
it's mostly the derivative space. It's not going to be, for instance, every gold bear market was triggered by futures. I know people who are very involved in the physical gold market, and as gold was crashing, like 2014, 2015, you could not get physical gold. You just couldn't get it. So the physical market was completely squeezed, but gold kept crashing. It doesn't. Once you create the paper market, it will distort. It will, it will, it means you can no longer look at the physical. Because I saw all these like very good gold guys, super bullish as gold was crashing, saying, "Oh, but there's no supply." It's like, yeah, I know there's no supply, but they create it out of thin air with futures and they roll it forever. And it's like they call it it's like a magnifying effect. So, and the cycles, and this is the main thing that I want to convey here because this is a very important question that everybody has is does that change the timing of the highs and the lows? No, it does not change the timing of the highs. It behaves the same way. It just looks different. For instance, without the buybacks, Binance Binance chain would have gone to, I don't know, it's going to go to 60. It should have gone to 60 or something or 10. But because there's a programmatic buying, it doesn't. It stays well bid at 200. And that's what you're seeing again. You're seeing it again today. Like it tends to enter these ranges where I believe Binance is more aggressive in its accumulation. This is partly why this is one of the few altcoins that I still own because this one is very, very managed by Binance. And when we go to Bitcoin, and to your point, Sandeep, I think that's what we're going to see. You're going to see a very managed range because every time it goes down, these guys are going to accumulate. And this is a fundamental reason why the bear markets have changed in crypto. They're no longer the same. Like I actually saw pure cycles analysts saying, well, okay, so it goes down 80%, the high is 125. That means is going to 25K. I was like, yeah,
Mhm.
no, that's not going to happen. That is just not going to happen because you're going to have all these institutions just pumping money into the market, keeping it afloat at about 60 at the lowest. Now, 75 looks conservative to me. I think this trend line may be retested by June. Let's bring liquidity back. And so if that's the case, more like 70K looks like the low to me. That it's more like more around that price. 70K is another round psychologically important number. The other one is this range here, which we could see that even when the Iran war broke out, you saw these dips below 65, 66, 65. that would be when I would expect strong buyers to show up. Because even though these guys, they are like the Michael Saylor were supposed to be immune to price, but I do believe this is just based on what Binance and Tron do. When prices go down, they tend to step up their purchases. They tend to be more aggressive if they find acceptable prices. So I'm not disagreeing at all. Uh, Normally, you would have expected a 20 Bitcoin to go back to 25K, but normally without the institutions, also I think you would have seen Bitcoin go to 250. So they contract the volatility. And then I'm not the only one saying that. There's plenty of cycles analysts. Like Martin Armstrong is probably one of the best ever to ever live. And he's been doing this work too, and he's asked that question too. And my answer, I'm not giving that answer because that's his answer. I'm giving that answer because I found the same to be true, which is the timing somehow doesn't change. Now I can't explain that. Keep in mind that using cycle analysis, man, let alone planets, to predict macro asset is quite um, uh, how do I say this? It's quite strange how it works. And it's based on empirical evidence. So when I say the timing doesn't change, I'm saying from experience, the timing just doesn't change. It always stays the same, which is why I believe there is an edge for us who look at time instead of price. Because when you look at price, those patterns do change. When people say, well, Bitcoin never goes to an all-time high before the halving, that's not true. It can, and it did last time. It did. And it was easy to, I predicted it. I'm on the record predicting a new all-time high before the halving in 2024 because the ETF got approved and everybody was super bullish on it. Easy. That's an easy call to make. I predicted that this would be the most shallow bear market in crypto history because of the presence of institutions and how this market has changed. Now, making that prediction based on two things: the fact that I'm seeing all this institutional participation in the crypto market, and the fact that I know from my previous work in cycles of stock market, bonds, gold, you name it, I know that the timing never changes, but volatility tends to contract. So what happens when more liquidity comes into a market is a vol comes down. I actually wrote a study on this in 2018, just showing how you can predict how high or low a crypto asset is going to move. So how volatile it is based on trading volumes. This is trading volumes will predict how much or how little the price will move. So if you have more participation into a market, which is what we have now with all these institutions, um, that will not change the timing at all. Like, and I know I'm very assertive with this, but I'm telling you, not at all. It doesn't change it one bit. You can still use the same tools to predict the same cycles that will always be there. One proof of that is the S&P. Switching back to, I'm not going to switch back yet to my forecasting tool, but Hearst running spectral analysis between, I think, 1900, 1975, or even beyond. I think it went back to the 1800s and 1970, 71 or 72, found a 54-month cycle in the stock market. And me using data between 1975 and 2025 found the exact same way. 4.5 years. It's 54 months, same cycle that Hearst talked about in the 70s. And how much has the market changed since then? The US economy has become more financialized. There's a lot more liquidity. Debt was not even an issue in the 1960s, then 1800s, let alone the 1800s or the early 1920s. The early 1900s. The economy changed. We went from agrarian economy to a more mechanized, manufacturer-based economy. Then we transitioned to the service-based. All of these changes took place. The amount of money that went into the stock market changed. The players that got involved, everything changed, but the timing didn't. 54-month wait, still there. You can still find it. It doesn't change. I don't know why, but the timing never changes. And that's just one of the call it one of the axioms of cycle trading. And it's why it's such a powerful tool because it doesn't change. It's always the same. Even though, for instance, just a quick example, this correction is if it goes to 70K, which let's just assume it does, because it's everything points to, it's very reasonable. This assumption is quite reasonable. 70K is a 15% correction. These corrections It's an 80-day cycle correction. These corrections used to be at least 25%. It's like the lowest. It would go down by as much as 50% during these times. Now it's 15, and that's normal now. This correction looks bad, but it used to be 80%. Now it was 50%. This is a 320-day cycle. These are corrections that in crypto you had to watch because the market could crash by 50, 60%. Now it wouldn't even do 30%. It's changed so much. And if you know what to look, so you look at, the timing doesn't change. So okay, when this cycle turns down, it's gonna go down for 2 months. You know that. It's like because the timing doesn't change. 2 months. All right, so we're gonna get a 2 month correction. Within those 2 months, used to go down 50%. But I noticed in 2024 that within many months, so this is a multi-month correction, a very serious correction from a time perspective, but it would never break on a daily closing basis, which is how I measure it. It would not break 30%. And this told me, oh, and I've been talking about this. Those of you who have seen me on the with Max, I've been talking about this with him at least since 2024. Uh, that correction in 2024 told me that the market has completely changed. Like this is a very different crypto market. It is at this time when I decided to stop shilling altcoins. Why? Because institutions are not into the altcoin stuff because it's
Yeah.
mostly vaporware. So that's when I said let's shift focus because institutions are not going to be start buying. They're not going to buy deep book or bunk. They're not going to get into that stuff. They're going to buy Bitcoin. They're going to buy infrastructure and they're going to build infrastructure on top of layer ones. So I changed my whole outlook based on the fact that from March through August, we have a multi-month correction. We're going down for 5 months. Bitcoin should have gone down like 50, 60% at this time, especially since maybe you guys are not aware of this, but funding rates were insane here. So the last time we saw retail going bananas on Bitcoin was actually in Q1 of 2024. We should have expected this. We should have expected this, a 50% complete collapse in the value of crypto, 53%. That's what we got. We got 50% in a month because we tested 30K in 2021. And I've been trading these markets very actively, doing all manner of strategies, trading volatility, doing cash and carry, doing all of this stuff. So I'm keenly aware of what's happening. So this is the last time in 2021 we had retail going crazy with derivatives and it crashed by 50%. You fast forward to 2024, same outlook because people were going crazy with derivatives and Bitcoin goes down 26%.
On
Half
that
as much.
one, I have a question on that now.
Yeah.
Because right now, you know that funding rates has been negative from last consistently for
Yes.
4 months, right?
Yeah.
And we did not have that before. That's also something very unusual we are seeing, right? I
Yeah.
see some other people also have a question on, paper always overpower physical. So in Bitcoin case, when we're looking at post market and option market, that's traded 10x more than spot, right? Almost like 9.6, but let's even it around. So it's 10.
Yeah.
And the thing is, right now we look at the liquidity, we know that there's a lot of liquidity sitting from 82 to 85K. That's somewhere around like 2 billion. But actually, there is more liquidity to the downside. The downside liquidity is somewhere around like 4 billion, right? And from that, and that's literally on 60s, that low. And from market maker, people who follow market makers method, and this is how market moves because makers they make the market. So the case you can make is they would like to grab that liquidity because that's how they make money, right? And they can start moving the price down. But here is the thing, and that's where you can do with the paper when you're trading perps and options. So perps options are traded 10x more than spot. Market makers to grab the liquidity, let's say they start moving the price down. But the thing is, actual price to move very down, you need to have actual distribution of spot. Spot has to be sold off. But on the contrary, what we are seeing every time when price is down, actually we are seeing more institutional buyers. So how do you kind of defend that case? Yeah.
Well, I saw a report from Crypto Quant that I'm trying to show you because I actually wanted to show you this. Um, ah, I don't. Let me see if I can bring it up here real quick. Oh, I need to log in. Come on.
But yeah, basically the case that I'm making,
Okay,
market
show.
makers do not have a lot of leverage to make the price down because the supply, because of supply squeeze and institution buyer, there's already very limited supply of spot available. Uh, And if they are moving down, the risk of actually imbalance is much higher. So even though for them to be profitable, it make more sense if the price goes up.
It
I take my words back. No, I shouldn't say that to be more profitable, but I would say like more like, if we talk about the balance and the long-term scenario. Um, I mean, yeah, price can go to like 73K, 70K, that's totally sustainable, but more than that can be very risky. In order for that to happen, there's a real distribution needed. And right now, looking at the data, I mean, whale accumulation is highest from 2013. It's literally 270,000 plus BTC they have accumulated.
All right, I found it. So here's something that I wanted to show you actually. This
Mhm.
is from CryptoQuant, so not an endorsement of CryptoQuant. I follow these quants, but I found that they're not good at timing. So they get very bullish at the tops and then
Mhm.
bearish at the bottoms. However, this chart, and I actually wanted to show you this, so I'm glad we're talking about this because this is they're tracking using their tools, which again, not an endorsement of them, but I do believe that there's something to this. Um, and so the way you read this chart is this is when so green means that spots and futures are growing. So there's demand from both spot and futures. These are the green areas. The orange areas is spot. People are buying spot, but they're selling futures. These are very rare occurrences. Then you have this is what the regime we've been in for a while. The longest is well, they only showed 2025. Spot contracting, meaning people are selling spot and futures are growing. And these guys have been calling this a purplet rally all along. They're saying it's actually perpetual futures that are moving this market. Now, and then they have the red areas where everybody's selling. So right now, according to them, the regime we're in is perps are growing, people are buying perps. So they're calling it a speculative rally because the spot activity, according to them, is not there. Now, I will say this doesn't make total sense to me because how do you explain the negative funding rates then? Because negative funding rates means that on balance people are shorting. But there's obviously this is not wrong. This is probably also part of what's happening, which is people are buying a lot of perps. In other words, these guys are making the case that all the movement you're seeing is perps. It's not. It's being led by the futures market. And how that works is that happens a lot because you can arbit. So if people move paper, you can buy and sell physical to arbit. And so oftentimes what you see with commodities is, in fact, this is true of all commodities. Commodities trade based on the futures market. They have is nothing to do with the physical market. Nothing. The supply squeeze on oil has been getting worse, worse, and worse, and worse, and worse since the war started. And yet oil is down from the March 10 top. That doesn't make any sense. And why is it down? Because Scott Bessent shorted with WTI futures on the CME, and people start arbing that and it filters all the way through to the Middle East. And this is pure financial engineering. So what I'm saying is looking at what the spot or the physical side of the market is doing is only one side of the picture. And if it is true, and I don't know the statistics for crypto. I know that for the oil it's like 200 times. Like I think I've seen crazy stats. Like sometimes there's more volume traded on a single day on WTI than oil moves throughout a year. It's an insane amount of dominance by financial products. And these created out of thin air, especially the ones that settle in USDT or USDC. These are paper markets. It's not Bitcoin. And everybody who says, well, it's different because 21 million, you're ignoring what's been happening with gold, for instance. If you look at the gold physical market, demand has been growing for far longer than price has been growing. And yeah, there are times when the price has to catch up to the physical market. But between now and then, it's dominated by paper activity. Like the gold bugs have been waiting, and they got their day in the sun. They finally got it. They finally managed. They not managed, but they finally saw. We're seeing now. This is my thesis for gold. It relates to Bitcoin in a second. But my thesis for gold is what we're seeing now is we're seeing the physical market take over the paper market because there's delivery and there's constant pressure to actually deliver that bullion, which is not something we had before. But with crypto, as it remains a very speculative asset, I'm just not seeing that pressure where people go, I'm gonna buy a perp and then I'm gonna take delivery. No, they're trading on hyperliquid. They don't care. They're just trading. They're gambling. This is more
See,
true in the altcoins.
I mean, the way I'm seeing this chart, this is really quite simple. The thing is, when it comes to perp, every 8 hours you're paying a funding rate. So perp trading is short term. That's not a long term at all, right? Your holding period maybe 20 days, 15 days, 30 days, right? Let's say, and that's even I'm saying longest. Because many people I know, they kind of literally trade 1 hour chart or 15 minutes chart on Bitcoin. So this was quite simple. We were seeing kind of rally in April, and that's where you're seeing the upside to the perps, right? This is where they're showing the volume. Um, and now because of, the cycle and that analysis, it's more like, oh, we kind of gonna go down. That's where and I showed you the other day those orders, right? The liquidation levels. And it was very clear there were more orders on the shore which can get liquidated versus on the lower side around 77. But then on when you look at the liquidity levels, when the price was at 60 or 65 in that range, because many people they kind of long it and then the price moved up, so market makers never grabbed that liquidity and the prices kept going up, or so that liquidity is now still there from last, I think that's 1 month liquid, 3 month, I think that's a 3 months liquidity, something like that. I showed you the other day. So that's like a different scenario. But yeah, to me, like the thing is what I was saying earlier, um, supply squeeze and basically, I think we both kind of agreeing on the same thing. And we have discussed this before, like, yeah, we're kind of seeing that the low price may be 70, 73K max, and we are seeing that, right? And then we will see it kind of going up, and it can be like, yeah, maybe do well, but it depends, means when the retail they start coming into the market, because right now they're not
I
here.
mean, the long story short is Michael Saylor is now going to take over. Oh, hang on. Your audio volume dropped to 50%. Not sure why. Zoom has an audio setting that I had to turn off on my own account. Automatically adjust volume because it kept lowering it constantly to almost zero. 70 core, 74K, 72K needed to hold, if not at least 65K. I'm with you, Ina. I think that's the outlook. Now, the reason I switched to
Yeah, me
Ethereum
too. Yeah.
is is we're still looking at the same crypto market.
Mm.
And look at the alts. Just look at the alts. You just go through the alts. I went through them yesterday briefly on Discord, and none of them had a bullish breakout. Not a single one of them. And actually, that touches back on the institutional thing in a moment because look what's happening with a more speculative side of the market where there's no automatic buying. Michael Saylor is not buying any of these. And look what's happening. Look what's happening. They're all making lower highs. They're all, well, Link, I guess, tried to break out of his range. Like all of these are following liquidity much more closely. So the point about what about the institution, you're seeing it. You're seeing it because it's a much more bullish market that you would otherwise see, but they're not going to overpower. I mean, I know it sounds like voodoo, but they're not going to change the timing of anything. And nobody's bigger than the market. And that's the other thing. Nobody is bigger than the market, which is why you have these spectacular hedge funds blowing up every now and then because you think, oh, they're dominant. They don't control anything. The market is too big. And supply is unlimited. Once you introduce this is what a physically constrained crypto market looks like. Let me see if I can delete this because it's what we used to have. Oh, okay. Yeah. So this is a physically constrained crypto market that has overwhelming demand and no supply. It looks like this. It looks like 2017. With the introduction of derivatives, I mean, it was just so obvious. If you were trading 17 and 16, I was. Then I traded 20 and 21. And man, it would crash because perp funding rates were too high. And everybody was taking on leverage. And I remember, again, I guess been right. I've been calling the market for a long time. I'm not always right. Um, I'll try and fix the volume before I finish this up. Let me see. I do this. Just gonna reset it. There's always a bigger player. Oh, exactly. All right. Boom. Uh, Phones noise removal, personalized audio isolation. That should have made it a little better. Perry, let me see. Low, 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 low. Is it better? No, it's very low. Is it low? Yeah, still low. I don't know what's going on with these headphones. Um, um, Audio settings. Um, Automatically adjust volume. Okay, so volume is turned all the way to max, but I think it's still low, right? Yeah, it is bad. I don't like this. Background suppression, personalized audio isolation. All right, so I turn it like this again, and it should get better. It should go up again. No? It Yes, no, there, better. Yeah, I have to reset it. I'm gonna get new headphones. Yeah, okay. So let's keep going. Where was I? Oh, okay. So this was a physically constrained market in 2017 because there are no derivatives. But if you fast forward, close all of this. If you fast forward to 2021, these crashes were all perps. There was no physical nothing here. It was just perps because perps were just, I was making, I made 130% in 2021. No, in like second half of 2020 and 2021 on a delta neutral strategy, just going into this high. I made 130% on a delta neutral strategy. Um, so it was insane. And it was just as easy to predict that it was so insane that it's going to turn around and it's gonna go bonkers to the downside. Like I wasn't sure. I suspected we were gonna get a serious crash in May of 2021, just based on perps. This has nothing to do with the physical market. It's just the amount of people who were just gambling on perpetual exchanges was going to eventually cause this. And now we have, I believe, a stabilizing force, which is the institutional buying. The institutional involvement has acted as a buffer to the crazy perp side speculation. And what we have now is a very contracted market that doesn't like to go up a lot. It doesn't like to go down a lot, and it hates the altcoins. And that is the crypto market we have today. And I think the perfect example of this is for some reason, I guess the institutional buyers are not into ETH, and he's already breaking the range, already turning down. It turned down on April 17th. That's even ahead of um so it's even ahead of Japanese N2. So you're already seeing the altcoin market turn lower and head down following. And for ETH and these altcoins, I would not even be surprised to see new lows. For Bitcoin, I'm not expecting new lows because you're already seeing Bitcoin beat gravity somewhat. Like it is rallying, it is much stronger than the rest of the market, but nobody's going to overpower the cycles. And nobody, because I mean, these gamblers can just completely, the swarm of gamblers on perp exchanges will overwhelm Sailor any day. Just like you saw these huge hedge funds, um, that GME story, all these very fun stories from 2021. People were just cornering the market because they knew there was a large short player. And these guys, what they were doing, they're buying calls. And when you buy a call, the market maker has to buy the stock because they're short the call and they have to hedge. So it forces buying of the actual stock by just playing on the derivatives market. And so there is an interplay between the derivative and the physical market. So you cannot ignore them. Price is set by all of this. And the volume is like I don't know what the volume like if I go to coin, let's see, let's go to coin market cap. What does Bitcoin trade on a single
Right
day?
now, volume is very low, and this is where you can say it looks like a dead cat bounce, right? And many technical traders kind of calling that. But the reason behind low volume is very obvious. When retail is not involved and the institutional buying, which is always, OTC desks, not on chain, then that's not going to show up in the volume.
No,
That's
but what I'm saying is Michael Saylor will buy $1 billion worth of Bitcoin, and that's a drop in the bucket because Bitcoin trades like 40 to 50 billion every day if you include all the derivatives. And this is a story as old as time. Oh, China's buying gold. Okay, that's fine. They can buy all the gold they want. It will still go down if people want to short it because they short it using perps. So it is not, it is no longer a physically price at the margin on crypto is set by perp exchanges. It's no longer set by physical. The physical market will act as a buffer to the crazy speculation you would otherwise get if people are just gambling on perpetual futures. Um, but it will
It's,
still the
it,
price will still be
it,
set at the margin
No,
in
no.
the perpetual
Okay,
exchanges.
hold on. And this is what I'm exactly saying. So, yeah, I get it. Hundreds of millions of people are shorting on perps on Bitcoin. That, okay, let's say we see that tomorrow,
Yeah.
right? But the thing is, in order for price to kind of go very down, there has to be actual distribution of spot from just call it people, not call it institution, but overall, right? But right now, this is where we are seeing, rather than having distribution, there has been accumulation, and that is the imbalance. Every time it had happened in the history, you take 2020 Tesla situation, you take Volkswagen 2008, you take nickel, like all these stocks, when it had happened, when the paper market was shorted, but there was a supply squeeze, price had went vertical. I mean, Tesla was up in 6 months like 720%. Volkswagen was up in 2 days 322%. That's been the historical data on the stock side, if there was a scenario like this.
No, I mean that can happen. There are times when the physical market, just for some reason, something happens and it steps in and it overwhelms the paper market. Um, for every time that you see these supply squeezes where there's organized buying to squeeze the short sellers, for instance, um, for every time that happens, most of the time that doesn't happen at all. The futures market just overwhelms whatever is happening on the physical market. And you're going to see in the future many short squeezes in the price of Bitcoin. You're going to see them just like we saw them in gold. Part of the reason oil was going so bananas is short squeezes. I mean, a lot of people just, I mean, like producers short oil because they're selling it. So they're, they're extracting and selling oil futures and they're short. They're always short. And these guys they weren't super short before because the price was kind of low, but you're always going to trigger a short squeeze if for some reason there's a supply squeeze. Not saying that can happen. What I'm saying is it won't happen now. It'll just be the same thing that it's always been, which is now you're seeing this kind of a tug of war, which I agree with you. You can see how, try to show you with this chart, how this move was not triggered by physical buying of Bitcoin at all. It was mostly perps. On net, there was physical selling. Now there's all the institutions that are buying. Fine, that's good. But if perps pushed it higher, perps will push it lower. Um, Beyond that, the timing. It doesn't matter who is involved in the market. It can be governments, it can be corporations,
No,
it can be
here
gamblers.
actually, Juan,
It
yeah, the statement actually, this rally that we just see, it's not by perps only. It's by
I'm going the data from CryptoQuant that shows on net physical selling and futures buying. That's
okay.
now what I'm trying to say is that statement that it doesn't really matter who's involved. It matters for the if you want to know how volatile a move will be or how the market is going to move, but the timing of the highs and the lows is not going to change. It will be the same. And if we have tools, which we do, to predict the timing of a top that are reliable tools, the top will come. It will happen. The short squeeze can happen when the cycle turns higher. but the cycle is turning lower now. So you're not going to see it. You're not going to see it just out of the blue supply squeeze when everything is pointing down. You might see it. There are chances to see these supply squeeze. Let me show you an example going back to my forecasting tool. Because on oil, you see a perfect example of this. Stop sharing this. Because in the price of oil, I was actually talking about to Marg about this yesterday because I was like, all right, so the cycle turned higher, and between these dates, January 26 and March 26, you see this dramatic surge in the price of oil. Now, this is a pure forecast. We don't even have, I don't think the model actually even ran. Yeah, see, so the blue line ends here, which means none of this was seen by the model ever. None of this was seen by the model. The blue line is only seen until, where is it? There you go. So it doesn't see anything from 2017 forward. The model didn't see anything. But here in this Q1 rally in oil, it didn't even have data. So there was not even data. So it didn't see that I hit all of this blue stuff from 2017 forward. So 10 years, pure forecast. But from January 10, 2026, there's not even price data. There's nothing there. And these are purely based on time. These are planetary motion to predict price. And what this is this triggers a war, and this rally goes bonkers to the upside between these two dates. That's when it goes bonkers to the upside because something happened that squeezed this market dramatically and it caused it to surge by 100%. But when did it surge by 100%? Oh, within the forecasting, within the time window for a rally. And this is when you see the supply squeeze within the timing window for a rally. If the timing is for prices, if the time is for prices to come down, they just come down. When it's time for prices to go up, they go up. And if the underlying fundamentals of that market at the time, at that rally window, within that rally window, if it is squeezed for some reason because, say, there's a war in Iran and the Strait of Hormuz is shut, then it can go crazy to the ballistic to the upside. But it will turn up, it will make a top when it's time for it to top out, and it will turn down when it's time for it to turn down, regardless of fundamentals. Because if we look at what oil did after this March, I'm going to flag these two dates because I think I have them on the chart. But I'm going to flag them on the chart because this is very interesting. It's a perfect example of this interplay between cycle and price behavior. Because this is a very squeezed market. The situation got worse and worse and worse. It was just not getting better. And yet the rally stops on March 10th. Stops. And then it's just cyclical. It goes up, it goes down, it goes up, it goes down. It trades with the headlines. And now the time, because of oil, probably has ended. And it's probably going to start rallying because it is time for it to do so. So when you're looking at, well, this person is buying, that person is buying, the market has changed in this fashion or that fashion. You're not looking at time. You're looking at price. You're looking at who's buying, who's selling. The timing does not change. Timing is an entirely different dimension to what can affect, that affects the timing with the times when it goes up and the times when it goes down. So what I'm trying to say with oil here is the time, according to the cycle, was for it to turn down. It didn't turn down. It just went sideways. Why? Because this market is very, very, very squeezed. And so supply is so tight, buyers are overwhelming, and so overwhelming sellers. And even though the time we're in a window for a correction, we didn't quite get the correction, which got a sideways volatile range. Now that we're out of this window, I think prices can go crazy to the upside in this market, probably on the back of some bad news coming out of the Middle East, because we've cleared this corrective window for oil, and now it's time for it to rally again. Crypto is the opposite. We're in the opposite situation. We're in a time window for a correction. So you're not going to see any squeeze. You're not going to see any parabolic move. You're not going to see any of that. What you're going to see is the price go down. Now, depending on what's happening fundamentally with that market, you might see the altcoins crash and make new lows, crash below or sell off below the February lows, but you may not see Bitcoin do that because it's much more well bid because there are more people interested in buying at these prices. And so maybe Bitcoin stays will bid, stays elevated, but it's not going to go up outside of the timing windows because when you use time tools to predict time, you get the windows, you get the dates when you may get rallies and the dates when you may get sells. And this is the whole thing that we're doing here is we're looking at time. We're not looking at price. If I was great at forecasting price, I would have looked at liquidity here, making new highs because it actually this is a high in late September, which lines up with this high in Bitcoin in October. And then it broke out. It broke out in April and it made a higher high in May. And Bitcoin's nowhere near as high as it was in October. So, of course, it's not a price tool, it's a time tool. And usually, time, again, I cannot explain it. I'm not going to sit here and try because it will take forever and we're probably not going to go anywhere. I'm not going to I can't explain it beyond this is empirically what I have found. Me and every other cycles analyst has found the same thing to be true, which is when you study time, somehow the market will just conform to your timing windows. Not always, because we're not 100% accurate, but I'm trying to make the case here that it's not just Bitcoin that's supposed to top out him. It's just not Bitcoin. It's a stock market. It's Bitcoin. It's oil. It's a treasury market. It is liquidity. It is a 10-year rate. It is everything I'm looking at. This May top shows up again and again and again and again in multiple asset classes. And it will be super strange if we see oil rally, stock sell off, and Bitcoin for whatever reason just go up. When the same models that are predicting all these moves, many of them already taking place, just ignores that and goes its own separate way entirely. And it will be even more strange because when you look at the altcoins, they are all of them topping out, topped out weeks ago. There are some exceptions like Zcash, but the others, they topped out on May 10. We had May 7, 7 and 9, and the highs on the 10th. You can go across all of it. This one's interesting too. They're also buying back their own supply, Pendle. So I'm keeping an eye on this one for maybe, and it's much more liquid. So like other than the guys who are buying, nobody else is touching it. Some of them are crashing. Like it hasn't quite. Bitcoin would need to break below this range here and just lose 79 entirely. We're days away from that, in my opinion. Just days, one headline out of Iran away from breaking down. And if it breaks down there, that's it. It will follow liquidity down. And the timing for the next rally is in June. And that's when it's gonna be. Let me go through these questions because I gotta go and
Thanks, Joan. This is very powerful. Thank you. And
yeah,
I'm
yeah,
gonna drop off. I have to like go to another meeting, but thank you. Very powerful. But I'll message you and then we'll talk more,
yeah,
okay?
yeah. We'll talk later. We'll keep this discussion. We'll keep
No,
this
this is
discussion
very
open.
powerful. Very good. Thank you.
No, 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 absolutely. My pleasure. We'll talk later. All right. I'll text you later.
Okay. Yeah,
Thanks for joining.
thanks. Bye.
All right. So metals have a secondary physical market that independently from spot when things get crazy, spot plus larger and larger premium. Cryptos don't have that same scenario. Maybe someday. Listen, the interplay, and Sandeep brought up some she's a very smart analyst, by the way, for those of you who don't know her. She brought up some very interesting points. There is an interplay between the physical and the derivatives markets. Absolutely. And understanding this interplay can allow you to spot moments when the supply is so squeezed that boom, it shoots higher. Or the opposite. This is why I was warning of a crash in May of 2021, because I saw that the price was dominated by futures. And people were paying crazy amounts. Like in May, I believe it was in April or in May of 2021, Ethereum on FTX, the same FTX that went bust a year later, was trading at a 25% premium over spot. Now, this is not a 25% annualized rate. It was trading 25% higher. The annualized rate was 150%. And people were buying that. People were actually buying Ethereum 25% higher than spot. That doesn't even make sense. And yet, that's what we were seeing in May of 2021. So it was obvious. And I was looking at some on-chain stuff too. That some people at Wise are very good at that. And they were saying that we were all seeing the same thing. Like, hey, prices are totally disconnected from like physical reality here. They're just going crazy to the upside. And I started warning in April saying, hey, this will crash. When this turns down and it's about to turn down, why is it about to turn down? Because the cycle is overdue. By May, April of 2021, we have not had a 320-day cycle correction for longer than a year. In fact, this month, this 320-day cycle, which is about 11 months, was running at 16 months in 2020 and 2021. So 60 months. It was very extended. So I didn't have all these fancy astro tools that I have now. But I knew the market was extremely overstretched from a time perspective. It had been rallying for too long. So the timing is we're gonna go down. That's the timing because it's been rallying for too long. And yes, I know for those of you who are new to this, that may not make any sense to you. Like, what do you mean it's been rallying for? There's a cycle to this, and it's rallying for too long is much more bearish than it went up a lot. Because if it went up a lot within its time window, that's fine. But if it goes up far longer than it normally does, that is your red flag. It's time. It is overstretched in terms of time, not in terms of price. Of course, it was, but crypto. This was nothing. This was actually up to this point the weakest crypto rally in a bull market. So from a price perspective, we knew that Bitcoin can do this and much more. So you could argue in 21, oh, Bitcoin has gone up a lot. It was only up 20x. It's been gone up 100x. Up until this point, it had been going up 100x. It went up 5x during a sideways range. It would double within 2 weeks during bear markets. So this was nothing in terms of raw price. You could not argue that it was overbought. It wasn't. It was overstretched in terms of time, though, the most since 2017, which also produced a crash. And unlike 2017, this was led by perps, not physical buyers. And so this interplay between the physical market and the derivatives market, if you understand that, you spot opportunities. And I believe Sandeep here, she's done awesome work on chain activity, who's buying, who's selling. She's doing great work there. And what she spotted is there's a ton of buying right now. A lot of people are buying Bitcoin. This to me confirms my thesis of the weakest bull market ever. Because the same people, and she showed me this also, the same people were selling here, which is why you get this volatility dampener. The same guys who were selling October, August, they were preparing to sell, offloading, the same guys are buying now. And we knew they stopped the rally. I believe they're going to stop the sell off. And I think that's the interplay now between physical and perpetual markets. Now, of course, if you're time-based trader, you don't care about any of that. It's just look at your timing windows. But there is value to seeing that because we trade price. I like to say that you study time here, but we're still trading price. And so you have to know, okay, when is it going to go up? When is it going to go up? When is it going to go down? But also have a sense of how much, when is the bottom? When is that going to take place? And when it goes down, how low can it go? Well, based on all the buying activity that we are definitely seeing in Bitcoin, it probably won't go down much. I don't expect new lows. That's certainly the case. I will say, though, it looks to me like a bunch of altcoins are following Japanese M2, and that one is a bit more bearish. But Bitcoin is like, it seems to be following this blue central bank liquidity line quite well. And if we fit it, and you shouldn't do this, this is a dirty trick that doesn't really work. So don't do this at home, guys. But if you do this, you just fit the liquidity rally to price. I will say this usually works. It's not perfect, but it's a technique that I use. Like, so you fit the last move that you know took place, and then you try to project the next move as a way to project or to predict price. This kind of works. Sometimes it will fail spectacularly, but sometimes it works. And it projects to 70K, so it's not a serious correction. And the reason I like 70K is that's 15%. And 15% is kind of what Bitcoin has been doing on this cycle. When the cycle was flipped, this is a bearish 80-day cycle. I think it was doing 15% also. Let's see if it did 15 or I think it did. It looks to me like it did less than 15, but let's see. No, it's just 15. So it was doing 15. You can see these 15%. You can see it here. That's another one. This is probably 15. Let's see. Oh, this is 20. So 20, 15. Okay. Another one here. Let's see. Was this 15 or 20? No, this is a little bit more. Okay, let's call it between 15 and 20. These are the types of correction that you get when the market is well bid, not bearish. Um, and if we get it, I will be pretty encouraged to see this. If we get a 15, call it 20% at most. 20% is probably 65. Yeah, 60, 66. Yeah, 66, 65. So 70, 65. If you fall into that range, the regime has changed. It's no longer bearish. You can't even say you're in crypto winter anymore. If it drops below that, if it breaks 60, fine, it can go to 50. But if it doesn't do that, and I'm not sure it will, because again, this market is well bid to me. You see how 79 and they step in, like they want to buy 79. And these guys are crazy. It's probably going to go below. But you can see the buyers step in. And as long as you see that, you can't be too bearish. You just can't, in my opinion. All right, so Perry's saying, can you please show some of the VTLs, 80-day, 240, 54-month on BTC and maybe ETH? The only one worth watching, Perry, is this one. This is the 80-day cycle low VTL. I actually have it locked. Breaking below this at this point, it just warns that you're going to get 60K. That's all it means. And we actually broke this VTL right here. We broke this VTL in mid-April, June. This was very bullish. This was very bullish because the 80-day cycle low VTL, it takes a while to break. Normally, in previous bear markets, it would take time to break this. These were, I think the one that broke in 22 was this one. I think it was in, September of 2022. This is your VTL, 80-day cycle VTL breaking after months of going down. This is by September 2022, it's been almost a year of falling prices. The high is in November. That's when you get the crossover. This is what stabilizes prices. Notice that prices are already stable ahead of the VTL crossover, but this VTL crossover confirms that you're entering a sideways range. The fact that we crossed that in April now is very bullish. This is the cyclical reason of not expecting new lows, because the VTL was crossed, and these signals are they're very strong. I remember them once failing only once in 2019 because of COVID. So the VTL broke, but the market may crash into new lows. But that's the only time I remember that it just failed. But other than that, they don't, and that's pretty encouraging. And other than that, Perry, we don't really have more VTL. That's the only one. This one. This one warns of 60K and potentially below. But I would say because we crossed this one, you would expect this to be the floor. So the floor will be here based on those two crossovers. So above the VTL, okay, we're 75, 72. We cross the VTL, we're almost certainly going to 60K or about 63. You know, it can go below. Let's use the intraday low, 60K. So it can almost certainly go to bounce off 60K. I will say though that things need to get really, really bad with the geopolitics or the macro. It needs to get really bad. Now, it is in my bingo card. Like maybe things get deteriorate here. The thing I'm worried about the most is oil. I have the dates highlighted because I don't want to do this switcheroo again. I don't want to switch it. So I have the dates here in oil. The reason that I'm concerned is because you know how the model turned up. The oil model turned up here. It was like January. I think it was January 20th. So it turns up here and prices went relentlessly higher. It turned down here and prices just remained stable, whereas we would have expected a correction. Now the cycle in oil turns up again. That has me a little worried because we already knew that when the 8-month cycle turned up on oil, there were geopolitical implications to this particular cycle. It turned down and the market just stayed at 100. It would not go below 100, just briefly at times, but it remained very, very, very well bid. What is oil going to do now that the same cycle that caused this rally, is turning up again? And it's stopping out in July, which lines up with the macro, by the way, in case that wasn't clear. So if the oil market goes bananas to the upside, you're going to see that may also have geopolitical implications. Let me put it that way. That may also be because something breaks again in the real physical world. And so that is what I'm watching the most. The I showed you when I started, I showed you the outlook for interest rates is for them to continue to climb higher. I don't see bonds continuing to climb higher if this Hormuz situation is resolved. So I'm doing a little bit of a Martin Armstrong type analysis here where I'm looking at my models and what they're saying and trying to walk my work backwards into what is going to happen in the world. That's not always perfect. I recognize that. In other words, just because I have these forecasts, it doesn't mean the bonds will begin dropping on Tehran again, but it might. And I've seen these work. It might mean the fact that oil is turning up again is the reason I think we're seeing all these turning points in stocks, in bonds, in crypto. It's the oil market that I think is going to wreck everything else. And we have the transmission mechanism now. There's talk of interest rate hikes, of course, because oil is not coming down. When it was time for oil to come down, it remained at $100. So how high is it going to go now that it's time for it to turn up? Now, I don't think it's going to go super high, and this is certainly not a trade recommendation. Maybe it goes to 120 again, but that would be brutal because maybe it goes there and it stays there for a while and before it turns down, or maybe it goes to 150 because 100 has been the prices have been gravitating around 100. And so I don't mean to sound like a broken record, but this situation is very serious and not resolved. And Trump just flew to China to ask the Chinese to help. It's like they're not going to help, dude. Uh, you caused this mess, you have to fix it. And he doesn't want to because, of course, you're going to lose face. The petrodollar will collapse. All of these reasons why the U.S. cannot pull out of Iran and just uh, let them run the strait on their own terms. They can't do that. So how is this going to be resolved? I just don't know. I have no idea. I do think, however, that it may be resolved around July, just based on the outlook for the oil market, which again turns more bearish after this July 15 top. Hopefully, we do have a July 15 top. And this is not what I want. This is just what I see. And we're seeing it in the metals market with gold selling off quite significantly. These used to be significant moves in gold. They're not anymore. There is an low in June for gold, so I'm not super bearish on it. But stock market is extremely overbought. They decided to ignore completely what's happening in Iran. But what I'm seeing is that these guys are telling the truth, and they're breaking out. All of these are the 2-year rate. Look at the 10-year rate, breaking out. 30-year rate, breaking out. If this continues, everything gets dragged down by this move. We're seeing it play out. This is my take so far has been this May top. We're seeing it play out. It's already happening. It's just not obvious yet. By the time it's obvious, if you're a trader, it's too late. Now, I personally not going to short it. I know that Ina, at least you will. Uh, maybe not, but I think you will. I'm not going to short Bitcoin here. I'm just going to do a strangle. Just capturing that volatility that I don't think we'll realize. That's my way of playing this because I see more of a range than a move that I want to trade because I'm more of a swing trader. It's just I see the trend changing in Bitcoin. I want to buy the low. I don't really want to sell the top. Um, but yeah, I think you're seeing it across the entire world. And I hadn't looked at the bond market until today. This is very serious. And the stock market is again all too willing to dismiss it. And that's a recipe for disaster. And crypto maybe also too willing to dismiss it, and they shouldn't. Bombs drop again, rates will continue to go up, then reflexivity kicks in and rates go up because rates have been going up. And then everything else goes down. And that is sadly the outlook between now and June, July. So Brett always says something like, show me the price action and I'll show you the news, or something like that. Showing the news is not the actual driver, but just a cover story. You could say, show me the cycles and I'll show you the price action and the news. Yeah, absolutely, Barry. It's just time. Time is the most relevant factor when trying to assess what a financial asset is going to. It's just time. Just look at time. If you look at price, you're going to get confused. And if you look at the so-called fundamentals, you're going to get very confused because you will have conflicting news. Like people saying, for instance, we just had this discussion. People saying, well, some think the physical market is constrained and people are buying, and they point to institutions Others are looking at, others are saying, no, 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 it's actually all driven by futures. You can never know. But with time, we know what time it is. We always know what time it is. And if you have tools that work reliably, that rely on time only, you can reliably dismiss all of that. And this is how I personally view markets, but you know that already. Are you still largely out of crypto holdings, maybe until mid, late June? Yeah, yeah, I'm out. I sold 82, 81. I was waiting. I sold a little bit ahead of that also. I trimmed my exposure and like I've been selling slowly since April 20th. But I got out completely last week. I have no exposure. I mean, I do have exposure, but only via call options in May. If I'm wrong, if this outlook is wrong, which I guess it's worth considering, and Bitcoin heads higher instead of lower, it's gonna be over the next couple of weeks. So it's gonna be over the next. So I have calls, long calls on the May expiration cycle in case I'm wrong, and I'm already shorting puts in June because it's June where I believe the bulk of the sell-off takes place, not in May. So for the remainder of May, like there is a chance. That's my view. Is there's a chance in May that it continues. Uh, as we head into June, there's no chance. It's gonna go down because notice that is June is when the stock market also turns down. So right now we have oil turning higher, crypto turning lower, but give it a couple more weeks and the stock market turns lower. And then every cycle is pointing in the same direction. So that's how I'm playing it personally, because still have some exposure via calls. What I did is I sold the spot that I had and I bought calls just in case I'm wrong. I like to trade that way. Yeah, just in case I'm wrong. So if it goes up, great. I think my delta is positive. Like I'm literally long Bitcoin still, very mildly though. It kicks in at 85. So between 85 and 90, that's when I get paid. If it goes up, I don't think it will though, which is why I sold the spot because I don't think it's gonna happen. But maybe it does. Um, Ina's saying there's probably a comment for something else, but if that happens, no matter if BlackRock is buying, they will de-risk. I think exactly is what will happen. The last scenario you're mentioning, I think it will happen. July or August will be the bottom. Yeah, I agree. I agree. And I agree with you too, Ina. I think what you're saying is, hey, if something bad happens, like oil begins to surge and the stock market goes, sorry, the treasury market goes crazy, yeah, all these institutional guys will start dumping. I agree. They'll turn on a dime because it makes sense. They're going to be bearish. Suddenly they're going to go, oh no, inflation is coming back and the data centers are at risk and whatever. They'll grapple onto something because they always do that. They will follow their narrative and the timing just like everybody else will. So I agree. This is mercenary capital. These institutions don't care. If they decide suddenly that the outlook is suddenly not so rosy again, they'll start selling. And we are time people here, or time traders, or astro or non-astro, but we're all looking at cycles. The cycle is about to turn down. That cannot be argued. Like that is without question, the cycle is turning down. Because the cycle is turning down, all of these narratives, all of these guys will just they'll do what they have to do to make prices go down because that's what happens every time. I mean, it just happens every time. And this will be no exception. Nothing's happening now to make us suspect, oh, this time will be different. No, it won't. It will be the same. It's so many models pointing to the same outlook that it's just very hard to dismiss. I'll just put it that way. All right, so BlackRock bought up that 15K dip, so I'm sure they won't let a peasant in cheap now. They won't sell either because they probably have bigger plans with it. There is a reason why BTC will have in its lifetime 33 halvings, as there is a reason ETH equals 33 in Gematria. I'm not gonna pretend I understood what you said there, sir. But but yeah, I mean, I what Sandeep said it makes a lot of sense too. Is if these big pockets think 65K is value, 65K is the bottom. 100% agreed. And it's true that people are shorting perps now because funding is negative, but that's a trade. I don't know about you, Ina. You're the trader in the group. I'm sure you're shorting here, I'm guessing. I'm sure you're gonna buy back if you get 70K. I mean, that's a great trade. If you took that trade on purpose. It's a good trade. I mean, you're not gonna overextend your welcome, I don't think. Um, Will you? I short the Pico top and I will get long again. I sold the spot as well, like you. Yeah, I mean, like this is there are times, admittedly, and February was one of those times when if you're at least looking at the macro outlook, it's kind of confusing because you have two leading liquidity lines, and they're not saying the same thing. And this is what threw me off, at least in February and March, is the fact that the blue liquidity line is super bullish, the other one is not, and Bitcoin sort of tried to follow both. And notice that February and March, it is following Japanese M2, but then we get into April, it follows the blue line. So kind of following both, trying to please both sides of the liquidity angle. And so that was somewhat confusing. We don't have that now. This is very different in May. Everything is pointing down. They agree. Japanese M2 and central bank liquidity, they agree. Prices are going lower. You look at the treasury market, it agrees. Prices are going lower. And if you look at, I think it was kind of confusing too, when you look at the um, the astro forecast, you look at this, and it was sort of confusing. For me, it was. Then I spotted something very subtle here. This is Bitcoin. This is Bitcoin. So we have the February 12 low, of course. That was inverted. So it showed up as a high, but it was a low. It was inverted. But then something subtle happened, which is March 11. There's a low on March 10 on Bitcoin. I'm going to show you in a second. So it flipped back to positive correlation, which means this May thing is the top. The reason I'm saying that is it was confusing too. It was a little confusing for me because the model was inverted, and what it was showing is there's going to be a February low, and then there's going to be a May low if it remains inverted. So it was confusing as well. We're not there anymore. It's very clear. The actual cycles are showing a top in May. The macro indicators are showing a top in May. Everything agrees. Bonds are showing a top in May. Japanese M2 shows a top in May. Central bank liquidity shows a top in May. There's no disagreement here. Whereas, admittedly, the February March period was a little confusing because the forecasting models were flipped, and we had two conflicting liquidity readings. The forecasting models are no longer flipped, and liquidity is saying the exact same thing across the board, and bonds are saying the same thing across the board. So there's no confusion here. This is not this is not like February and March. This is clear, at least more clear. Now, famous last words. Maybe I'll get completely wrong if Bitcoin goes to 90K next week. But I'm not expecting that. You know why I'm not expecting that. All right, so let me read the final comments. I'm just going to wrap up here because I really have to go. Uh, so I need to see at least triple bottom, and I'm not convinced yet. Oh, okay. I think traders will panic once we lose sub 70K. But being honest, I was feeling bullish in the top. That's the reason I got short. Ha! That's good. No, that's good. Yeah. Like I rely on my models a bit more, So I was like, this feels good. Price action looks very bullish. And I was looking at all these bullish things and both bullish report, everything's bullish. But then I had to keep myself honest and say, hey, of course it's bullish. That's what these indicators are showing. Like they're literally showing that it's gonna be bullish right up until early May, and from there it turns bearish. And I have to say it did turn bearish because I said yesterday in this one, I stand by this. The only thing that could have negated this bearish liquidity outlook is this Clarity Act thing, which did make the price of Bitcoin rally. We lost all of those gains. We lost them today. That's quite bearish because the rest of so the underlying models are bearish already. And sure, Clarity Act, news, like specific news that relate to the crypto market can change the cycle, can alter the cycle. I've seen that. It's rare. It's very rare. But you have to watch for these potential catalysts. Um, we had it yesterday, and now it's like the market doesn't care. It doesn't care that that happened. It doesn't care about clarity. I think it will care about clarity going into the actual vote of the actual bill. Yesterday was like a procedure, like a markup vote or whatever by the Senate Banking Committee. It's like, yeah, this is not it. It could have been it, but it wasn't. And again, I think the altcoins tell the truth a bit more here. They're already breaking down. They don't have a narrative. They don't have Michael Saylor. It's just, I mean, look at this. Look at Solana. It is following liquidity. Why are we thinking it's going to be different this time when it hasn't been? Look at this zoom in. By the way, I'm not zooming into CurveFit. I'm zooming in because of this weird candle that took place on Binance. So I have to zoom it in. Zooming it in here. It's been following liquidity for months. Why would it be different this time? In fact, what I noticed about the altcoins, and it worries me a little, and I think Ina, you might agree. Um, the altcoins are following Japanese M2. Clearly, they're not following the other one. They're following Japanese. Look at this surge, and somehow the alts managed to match the damn surge. I just couldn't believe it. What I saw was like, wow, that's crazy. Like they're mimicking, and I'm on the record saying I don't think crypto's gonna do it. It did. At least the altcoins did. And so look at this. We're not making this is a leading crypto asset. This is Solana. This is not Pendle. All right. This is not CRV. And it's following liquidity. 84-day offset. And it's topping out and it's heading lower just as ferociously as suggested by liquidity. Why would we look? This is not complicated. If you have a model that you know is good and prices are following that model, expect that to continue. Don't second guess it. It's like you're cheating on yourself if you do that. Once we have the outlook, once we have the models, and you can see clearly, because this picture is clear, guys, it's following liquidity. Well, chances are it will continue to follow liquidity. And if it does, the low is in June, and we're headed much lower. And that is as simple as I can put this. It's very simple. The odds favor this. There is an off chance because markets are probabilistic that maybe it just goes higher. There is a chance, of course, there is a chance, but it will probably just keep going down. Let's just face it, because it's not just Bitcoin, it's oil, it's treasuries, it's the stock market, it's the altcoins, it's liquidity, it's interest rates. Everything says the same thing. So again, this is not February. This is much more clear this time. All right, so let me read your final comments and I'm gonna go. We fade the all record buying from Sailor. Oh, I didn't know. I didn't see that. I didn't see that it was all record buy. This guy will not overpower the market the same way that I don't know. We've seen these actors come. Roger Ver, guys. I mean, you remember Roger Ver? November 2018. November 2018, Roger Ver teamed up. I love Roger. I got to meet him once in Seoul. You probably wouldn't remember this. I love him, but he thought he could overpower the Bitcoin network. And these guys were big whales. They own loads of Bitcoin. They controlled most of the hash rate and they wanted to change it and they failed miserably. Nobody overpowers the market. There are more stories like that. Justin Sun, the founder of Tron, he bought up the bulk of the Steemit supply. There was this shitcoin called Steem. He bought most of it because he wanted to fork the network and change some things about it. He failed. He was half the market and he still failed. He was half the market. He failed anyways. There's time and again, you see these stories. The Hunt brothers in silver, I think 19, Perry, you may know the story. 1980s, 1970s, the Hunt brothers, they corner the silver market. They buy it and the market crashes. Craters completely. In fact, despite these guys being the market, these guys became the market, it still crashed. Like it crashes. It just don't overthink it. Oh, this guy's, it doesn't matter. It just doesn't. Markets have a life of their own. And so, yeah, that's what it is. So let me read this. So Stretch just posted its biggest volume day ever. 15.3 million total shares, topping April 14th's previous record. 14.8 million cross threshold for 8,104 Bitcoin estimated. Second largest ATM day on record. Only April 14, 14.7 was higher. Ex-dividend tomorrow. So that was easy. Oh, interesting. That was yesterday. So Stretch just posted a video. Oh, that's the same thing. Yeah, I'm worried about that too. Been following Sol every day. ETH and Sol looks very bad. Fully. Yeah, they look horrible. Honestly, though, if you have the liquidity tool, bad is good because they're following the model much more closely than Bitcoin. So bad is good in this case. Hunt Bros almost had it. Yeah, but they didn't. If I recall, the banks and exchanges had a law changed that said the brothers couldn't get any more delivery or something. Yeah, that's how it is. I mean, the rules change, and now yes, it can go down. They probably hiked the margins and they did all these things. but the story as all this time remains. I mean, guys, people were probably back in the tulip bubble days. They probably were saying the same thing. Oh, no, 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 but the queen is buying all the tulips. The queen has all the tulips. It will never crash. And it crashed because it always crashes. It never changes. Yeah, margin changes. They always, that's a classic move. Margin changes. Volatility goes up and then they just change the rule. But like we were not alive at this time. But people probably thought back in those days, the tulip mania, they probably thought, yeah, this is a little crazy, but look at all everybody's buying. Everybody's just keep buying because everybody's buying. And then the cycle turns, boom, it crashes. Because that's what happens. Tulip coin, it's gonna win. Yeah, that's gonna be a good one. All right, guys, I gotta go. I gotta pick up my daughter. This was super fun as always. The recording will be available later today, and it's gonna be posted on YouTube maybe on Monday. I don't know, because when picking up my daughter and when my daughter's here, I barely have time for work. But it was super fun as always. I'll see you on Discord. Let's see if we get the sell off. I think we will. I think we're getting the sell off. But if we don't, I mean, that's going to be even more interesting because if Bitcoin doesn't go down to 70K now, why? That's every reason to do so. So it will be even more interesting if it doesn't. Anyways, ciao, everybody.